Hey friends, in this video, I'll show you how to trade short strangles on interactive brokers. By the end of this video, I'll demonstrate step by step what you need to do on interactive brokers to make trading short strangles possible. I will also explain what short strangles are in a beginner-friendly fashion so that you can earn additional income. If you aren't sure, my name is JJ. I share my journey in becoming a better options trader to earn more money outside my full-time job. I want to paint a realistic and no bullshit manner when it comes to options trading. As a disclaimer, this video is for entertainment and educational purposes only. If you already know what a short strangle is, skip to this time frame for me to demonstrate immediately on interactive brokers for you. Trading short strangles is actually extremely dangerous, and I recommend you to really try it on paper money first before you even use real money. Before we proceed with the demonstration, let's know what short strangles are. A short strangle is an options trading strategy that involves selling both a call option and a put option with the same expiration date but different strike prices on the same underlying asset. The first part of selling a short strangle is selling a call option. So I'll sell a call option over here, and this is just a random level I've chosen, which is 184. Selling a short strangle will also involve selling a put option, which is over here, which I've tentatively put at 170. Let's assume I sell a short strangle with a 45 days to expiration. I'm betting that gold will not exceed $184, and I'm also betting that gold will not go below $170. Essentially, you're betting that the stock price might go up, down, but they would stay between both levels of 184 and 170 over here. A close cousin of a short strangle would be the iron condor strategy, of which I'll share in another video. But one thing I must say about a short strangle, it is extremely dangerous, and I'll actually recommend no beginners to try this. In my experience of selling short strangles, it is most important to trade it on things that are not highly volatile. My preference is to not trade it on things that move a lot. Let's take a look at Tesla, for example. The fluctuations for Tesla is extremely huge, and this is a case where you do not want to trade short strangles on. My preference when it comes to trading short strangles would be on things like gold or the X sectors of the S&P 500, which might be XLK, XLV. Okay, maybe not XLK. XLK is a terrible example. I usually trade it on like XLE, where the price of the underlying asset does not fluctuate much. The term short in this context means you are the one selling, writing the options, not buying them. So this means when you sell a short strangle, you immediately collect cash. Here's an example of some short strangles I've traded myself. I've sold a call option at 186.5 for gold, and I also sold a put at 172, which is over here. I believe I collected about $250, and I actually closed the strangle when it was 50% in profits already. I believe I only closed it yesterday, so I earned about 127 USD, and I actually opened another short strangle with these two prices over here. The goal of this strategy is to collect the premiums from selling both options with the hope that the options will expire worthless if the price of the underlying asset stays within the range. As long as gold stay within these two price ranges of 184.50 and 170, I will earn money. But usually in this case, I will not hold the strangle until expiration because it's just too risky. I'll usually open a strangle with about 40 days to expiration just to give it a lot of time, and I'll ideally want to close it within a period of 21 days. So in this case, I closed it when there was actually still 27 days to expiries. I want to close it as early as possible once my profits are baked in. I'm very happy with a 50% profit target for short strangles. If I can scroll down to the dangers about short strangles is that there is unlimited risk. This is very similar to selling a naked call and naked put. I'll not recommend it for beginners at all, but if you're a beginner and want to dip your toes into selling short strangles, I will always recommend putting a stop loss, which is what I'll also demonstrate on interactive brokers shortly as well. I actually got this strategy from the Unlucky's Investor's Guide to Options Trading, and I'll recommend everyone picking up this book to learn more about options trading. The first thing for interactive brokers, unfortunately, in my experience, you can't really trade it on the platform itself. What I would do is to download this program called the Trader Workstation. You can just go to Google, type interactive brokers trader workstation download. It is available for both Mac and Windows. You'll land out on this website. You can scroll down and just download TWS software and click on the latest. Once downloaded, you should be able to log in into your paper account. If you don't have a paper account, log in into your main account on Interactive Brokers, create a paper account from there. If you need help on this, let me know in the comment section and I'll create a separate video for that. When you log in into your paper account, it should look something like this. The first step is to make sure this lock button here is unlocked so that you can make changes to the layout. Click on new window, click on options chain, and this complicated thing will open over here. This is the options chain. Click on new window again, click on portfolio, click on new window, click on order entry, click on order management, click on orders. The next step to trade short strangles is to select what you want to trade on. In this case, I'll select the ticker gold. I'll choose 41 days. The next important question to ask is what strike price will you choose? You can choose it based on support and resistance. My preference is to trade short strangles within a 1 standard deviation from the current price of gold. The price of gold right now is 178.27. So the next variable I need will be IV. I'll then go to interactive brokers and see what's the IV over here. It is 11.3. I'll then go back here, click on 11.3. Number of calendar days simply means what is the date to expiration for a particular option. In this case here, it will be 41 days. These two are the price ranges from 1 standard deviation of the current price of gold, which is at 178. In layman terms, it essentially means that I will sell one naked call at 185 and I'll sell one naked put at 171. It'll be at 185 over here. It'll be at 171. I'll click on strategy builder, click on 185, scroll down to 171. Remember to click on sell, okay? Sell. Don't click on buy. If you have selected it correctly, it should appear over here as short strangle. It'll tell you how much you'll earn. It ranges between a bid and ask price of $1.42 to $1.31. If you trade one contract, that means you'll earn about 130 to 140 USD. The margins you'll need for this trade is about $3,000. Do make sure that your account size is big enough. If you're unsure, click on profile. You have a 76% chance of winning. The max return you can get is $132. The max loss, this is where the dangerous part comes in, is unlimited. For example, the market crashes and gold price drops to $112. The TLDR version of it is that you'll lose a lot of money. If I sell a put here at $171, it essentially means I'm promising to buy 100 shares of gold, and this promise will be valid for 45 days. The price at which I promised to buy gold at would be at $171. One gold is $171. 100 stocks of GLD would be 171 times 100, which would be 17,100 USD. So the worst case scenario, if that happens, right, you need to spend 17,000 USD to buy 100. And this is the most dangerous part of selling short strangles. If you do not understand the concept of selling naked put and naked calls, I would not recommend you to sell short strangles. But this is just for theoretical purposes, and I'm all for teaching you how to theoretically learn how to trade short strangles before you actually use your real money. To proceed on, I'll click a particular price that you want to trade at, which might be at $142. You click submit order, and then you can see how much money you'll collect. In this case, I'll collect $139. Most of the time, I won't let my short strangles expire worthless because it's just too dangerous. I'll usually exit the trade when I'm at a 50% profit. Let's go back to this trade I made. I entered this short strangle on the 20th of June and I exited it on the 30th of June. So within a period of 10 days, I earned about $127. Initially, I collected, if I'm not wrong, about $240, but because my trade was already 50% profitable, there were not much movements within gold itself. The short strangle then became profitable for me and I therefore closed it. When you close a particular short strangle, that means you no longer have the obligation to buy 100 gold at $171, and you also no longer have the obligation to sell gold at $185. If gold, let's say for instance, shoots up to $1 million, that is also troublesome because when you sell a call option over here, you're essentially promising to sell 100 gold stocks at $185. And that's the whole reason why I wouldn't recommend beginners to sell short strangles, because if you sell short strangles, you can potentially also lose a lot of money. I know how to manage a trade. I know what I'm doing. That's why I don't mind trading short strangles myself. Even in my experience, I'll also put stop losses at 200%. What do I mean by that? Let's say, for example, I made this trade, I earned about $269. 200% stop loss would mean that my trade becomes unprofitable. If the price of gold fluctuates to a certain point where it's actually worth negative $538, when I actually collected $269 for it, that is when I'll need to exit the trade. When it is in the loss, it means either that the price of gold is very near to one of my strikes accordingly. It could be very near to the price of 185, or it could be very near to the price of 171. I'll then put a stop loss to make sure I exit the trade. The most important thing about trading short strangles is that you can have unlimited loss. You don't want that to happen. I'll always recommend anyone who even wants to think about trading short strangles to always put stop losses. Going back to interactive brokers, once you click submit order, click on transmit. Once you get a fill, you will have collected $132 in cash. When it comes to setting a stop loss, I'll click on the short strangle itself, click on sell, click on the number of contracts you have, click on limit, click on down button, and click on STOP. I'll click on day, I'll click on GTC, which is good till cancel. So how do I calculate a 200% stop loss? When I sell one short strangle, I'll collect about $142. The price of a short strangle when I sold the short strangle would be worth $142. But if the price of gold fluctuates close to these strike prices of 185 and 171, it would be worth a lot more. I'll take 172 multiplied by 3, which is $426. Why do I put $426? Because if the price of gold fluctuates too near 185 or 171, it would be more expensive for me to close the options trade. The short strangle, which was worth $142, is now worth $426. So if this happens, if I were to close my options trade, I'll immediately lose a sum of $284. And $284 is 200% of $142. That's the reason why I take 142 multiplied by 3. Multiply by 3 because you initially collected $142. But when you want to close the trade, you need to pay back money to close the trade. If you need to pay back $426, this will result in a loss of $284. I'll go back to this, put a stop loss at $4.62. I'll click submit. It'll deduct $426, and this matches up to the math that I have on my Excel sheet over here. I'll then click override and transmit. What this stop loss is doing is essentially telling interactive brokers, if my short strangle is worth $426, I want to close the trade. What we want in options trading is the opposite, however. You want this short strangle to be even cheaper than before. One contract of the short strangle you sold was worth $140. Your objective is for it to drop to a price of 70 cents. If it drops to 70 cents, the short strangle which you sold at $142 is now only worth $70. Because you sold something that was worth $142 and then its price is reduced to $70, you can then make a $70 profit. And that's the main thought process of selling a short strangle. I tend to play it a little bit risky, so I actually do sell short strangles on some stocks which are highly volatile. Coinbase is actually one stock I'm trading short strangles on. It is highly volatile. When a stock has high volatility, the premiums you get is a lot more. The margins that you'll eat from your buying power is actually a lot more. If you can take one thing away when selling short strangles, I will always recommend to put a 200% stop loss. I'll always recommend to close short strangles when you're 40% or 50% in the money, just to make sure that there is not a high risk of you being assigned the particular stock itself. I always trade short strangles with a duration of about 40 to 45 days. That's where I'm comfortable with. Anything below 21 days or even 25 days is a bit risky for me already. So I want to close it out as early as possible and only trade it on things where I can have time to manage just in case where shit happens accordingly. So if a short strangle like this happens on Coinbase, right, you lose a lot of money. And that's why you need to put a stop loss to cut it immediately when you are at negative 200%, when you have already lost 200% of what you have earned. I do trade short strangles quite regularly, but I would say the most important thing is to diversify your short strangles to make sure you're not trading short strangles on one market. Also make sure to have long dates to expiration and take profits as early as possible when you trade short strangles. That's it for this video. Let me know if you have any questions accordingly. Check out these videos on how to roll your naked call or put option, and I'll see you in the next one.